So today, I will be discussing Chapter 8 of your book, Adjusting Entries. Before that, let me introduce to you the learning objectives for the chapter. Number 1, enumerate the common end of period adjustment. Number 2, prepare adjusting entries. What are adjusting entries and the nature of adjusting entries? Number 1, adjusting entries are entries made prior to the preparation of financial statements to update certain accounts so that they reflect correct balances as of the designated time. These are made usually in the end of the accounting period to update the account. In other words, adjusting entries are prepared merely to update the balances of accounts. Adjusting entries make it possible to report correct account amounts on the balance sheet and on the income statement. A company must make adjusting entries every time it prepares financial statements. The reasons why adjusting entries are needed, and these are the timing issues. First issue, time period assumption. Second issue, accrual and cash basis accounting. Then we have revenue and expense recognition principles. And we have the fourth one, matching principle. So let's start with the time period assumption. The time period assumption subdivided the economic life of a business into artificial time periods. And this can be a month, a quarter, a semi-annual, or a year. It also classifies the annual accounting period into fiscal year and calendar year. The time period assumption is also known as periodicity assumption. Next, we have comparison between cash basis accounting and accrual basis accounting. Cash basis accounting. In cash basis accounting, revenues are recognized when cash is received. Expenses are recognized when cash is paid. Cash basis accounting is not in accordance with the accounting standards. What about the accrual basis accounting? The accrual basis accounting record transactions in the periods in which the events occur. Revenues are recognized when earned rather than when cash is received. And expenses are recognized when incurred rather than when paid. Next, we have the revenue recognition principle. Under the revenue recognition principle, revenues are recognized in the accounting period in which it is earned. Revenues are recognized when earned rather than when cash is received. The expense recognition principle recognized expenses in the accounting period in which it is incurred rather than paid. Expenses are recognized when incurred rather than when cash is paid. Then we have the matching principle. The matching principle states that expenses should be matched with revenues in the period when the company makes efforts to generate those revenues. It says that let the expenses follow the revenues. The adjusting entries are needed to ensure that the revenue recognition and matching principles are followed. Next slides, we will be talking about the important topics to recall when you prepare the adjusting entries. First is the accounting period. Second, the normal balances of accounts. Third, the real and nominal accounts. Let's start with an accounting period. What is an accounting period? An accounting period is a period of time that covers certain accounting functions. It can be either a calendar or fiscal year. It can be also a semi-annual, a month, or a quarter. Accounting periods are created for reporting and analyzing purposes. The annual accounting period can be subdivided or can be classified rather into two types. So you have calendar year and the fiscal year. The calendar year is an annual accounting period that would start January and would end December of the same year. While the fiscal year is an accounting period that starts any month of the year except January and would end the month of the next year that completes the entire whole year period. Then we move to what is a cutoff period. The cutoff date or the cutoff period is the point in time that delineates when additional business transactions are to be recorded in the following reporting period. The relevance of cutoff period in relation to adjusting entry is that this is the only time adjusting entries are prepared. This is the primary reason why adjusting entries are called end of the period adjustments. Next, we'll have the normal balance of accounts. So we will recall we have assets, liabilities, equity, drawing, income, and expenses account. So for assets, we have debit. So all assets are having debit balances, asset accounts. Then liabilities, we have credit. Equity, we have credit. Drawing, we have debit. Income has a credit balance. And expenses has a debit balance. This is important because it is when you know the normal balance of accounts, you would be able to determine what to adjust, especially when we will be talking about referrals and pre-collections. Next, we have the real and nominal accounts. Real accounts or balance sheet accounts are assets, liabilities, and equity. Then nominal accounts are income statement accounts, and these are your income and expenses. We now proceed to the types of adjusting entries. We have accruals, deferrals, recognition of depreciation, and recognition of doubtful accounts. We will start with accruals. Accruals are of two types, accrual of expenses and accrual of income. First, we have accrued expenses, expenses that have been incurred but are not yet paid as of the cutoff date. These are recognized in the period regardless of the date of payment. Examples of accrued expenses are unpaid salaries, unpaid interest expense, unpaid utilities, unpaid insurance expense. The pro forma entry to record adjusting entries is a debit to an expense account and a credit to a liability account, or debit expenses account, credit accrued expenses, or expense payable. Illustration number 1. For the month of December 2019, HBB Refrigeration and Air Conditioning Services used a total of 1,800 worth of electricity and water. The company received the bills on January 10, 2020. When should the expense be recorded? December 29 or January 2020? The answer is December 2019 because the expenses were already incurred December 2019. Illustration number 2. On December 30, 2019, the Triple D hired a daily wage worker for the maintenance of the office. Triple D follows the calendar year as the accounting period. The daily wage of the worker is 300 or a weekly salary of 1,800 for 6 days, except Sundays. Triple D adopts a weekly salary scheme and pays every Saturday. Let us assume that the calendar December 30, 2019 falls on Monday. This would imply that December 31, 2019 falls on Tuesday, which is the end of the accounting period. What are the implications? First, starting December 30, 2019, salaries expense are incurred daily. And that's the hiring date. Then we have cut-off accounting records is December 31, 2019. So if you're going to count from December 30 to 31, that would be 2 days. Payment of weekly salary is January for 2020. That would be the next accounting period. So how much should be salaries that would be accrued for December 2019? This is the computation. 1,800, that's good for a 1 week salary, divided by 6 days, times 2 days, 30 and 31, and that would be 600. So your adjusting entry is a debit to salaries expense 600 and a credit to salaries payable 600. Then we now proceed to accrued income. These are income that have been earned but are not yet collected as of the cutoff date. These are recognized in the period regardless of the date of collection. Examples: uncollected rent, uncollected interest income, rendered services but not collected, uncollected insurance income. The pro forma adjusting entry for accrued income is a debit to accrued revenue and a credit to revenue account, or a debit to receivable or accrued income and a credit to income account. Illustration number 1. Triple D apartment admitted a tenant who will occupy a room with a monthly rate of $12,000 on December 20, 2019 for 6 months. Triple D will be paid over 20th of the month, every 20th of the month. How much is the rental income to be recognized on December 31, 2019? The computation. The 12,000 is good for 1 month and will be received every 20th day of the month. So, for the month of December, how much should be income collectible from the 12,000? So, remember the payment will be, if we will be talking about December 21, your income or the rent for December 21 towards to the end of December will be collected the 20th of January, the next accounting period. And that 21st to the end of December will be already income on the part of the apartment. So we will be recognizing that one as accrued rental income. The computation would be 12,000 times 10 over 30, or 12,000 divided by 30 days times 10 days. The answer is 4,000. So to record is a debit to accrued rental income 4,000 and a credit to revenue income or revenue or income 4,000. Or it's a rental income of 4,000. Illustration number 2. ABC Corporation received a 12,000, rather a 12% 100,000 one-year note receivable on April 1, 2019. ABC used a calendar year period. The principal and the interest on the note are due on April 2, 2020. How much is the interest income to be recognized on December 31, 2019? So for that, let me introduce to you the formula to compute for interest. Interest is equal to principal times rate times time. So you have the I is equal to interest, P is principal, R is rate, A is time. So for our computation, you have interest is equal to 100,000 times 12% times 9 divided by 12. So where did I get the 9? Okay, the note was received April 1, 2019. The note will due April 2, 2020. So if you are going to count April to December 31, that would be exactly 9 days earned interest. Okay, that is why we have 100,000 times 12% times 9 times 12, 9,000. So the adjusting entry to record the accrued interest income is a debit to interest receivable or accrued interest income of 9,000 and a credit to interest income 9,000. Next, we will be talking about deferrals. So supposedly, I would be presenting to you this one first, deferrals. So in deferrals, we will talk about a mixed accounts. So under the deferral of either prepayments, there are two types of deferrals, the prepayments and the pre-collection. At the end of the accounting period, the prepayments and the pre-collection will become a mixed accounts. When you talk about mixed accounts, it is an account that is composed of a real and nominal accounts. So what are you gonna do with the mixed accounts? You need to prepare the adjusting entries to separate its component, because it has real and nominal, or it has your income statement and your balance sheet account. So you have to separate both. Separate the real accounts and separate the nominal accounts, because the real accounts will be presented in the balance sheet and the nominal accounts will be presented in the income statements. So we will now be talking about deferrals. So we have, for deferrals, we will be talking about the prepaid expenses and the unearned revenue or pre-collected income. Okay, so we will start first with prepaid expenses. The prepayment has been partly utilized, okay, at the end of the accounting period. So examples of prepaid expenses: prepaid insurance, prepaid advertising, prepaid rent, prepaid interest, supplies on hand. So there are two methods of recording prepayments. We have the expense method and the asset method. Under the expense method, the term expense implies that this method uses expense account at the time of payment. So examples: payment of advertising, we have advertising expense; payment of insurance, we have insurance expense; payment of rent, we have rent expense; payment of supplies, supplies expense; and payment of interest, interest expense. So in the problem, if you would see this expense account, it would tell you that the prepayment used expense account during the time the payment was made. So the pro forma entry for prepayment. So this is the pro forma entry to adjust, or pro forma entry when the payment was made, and the pro forma entry when the adjusting entry has to be made on the cutoff date. So for the payment of expenses at a time, for the payment of expenses, we have a debit to expenses and a credit to cash. This is your entry when the payment was made. Then the pro forma entry to adjust during the cutoff date is a debit to prepaid expense and a credit to an expense account. So for here, since the existing account title is an expenses or an expense account, then at the end of the period, we need to recognize the asset portion and reduce the recorded expenses. That is why we have a debit to prepaid expense and a credit to expense account. Example: on March 1, 2019, Elaine Jewelry Shop paid the rental for 12 months, amounting to 30,000. The business follows the calendar year. So this is good for a one-year payment, one-year rental payment. So entry to record upon payment is a debit or rent expense, since we will be using the expense method. So it's a debit to rent expense 30,000 and a credit to cash on hand 30,000. So at the end of the 2019, that would be December 2019, December 31, we need to adjust the recorded rent expense. So since the existing or the method used when the rent expense was prepaid is an expense account, so to adjust, we will be recognizing the asset account, and that would be prepaid rent. But before we can do that, we need to determine what portion is income already, rather expense already, and what portion should be asset. First, we need to determine our monthly expense. So the 12,000 is good for, rather, the 30,000 is good for 12 months. So 30,000 divided by 12, we have a monthly rental expense of 2,500. So our prepaid rent would be equivalent, or the asset portion would be equivalent to 2 months. So that would be 2,500 times 2. So that is why we need to debit prepaid rent 5,000 and credit rent expense, reduce the rent expense by 5,000. And the expense portion is equivalent to 10 months. So this is what will happen when you post the adjusting entries. So upon payment, what exists or what existed is rent expense. So you have there an entry March 1, 30,000. Then at December 31, 2019, you need to prepare the adjusting entry. So after adjustment, you will now have a new account, prepaid rent. So if you recall, our adjusting entry is a debit to rent, prepaid rent, and a credit to rent expense. So this is our credit. So at the end of the period, what will happen? Your rent expense now will have a balance of 25,000 that is good for 10 months, and your prepaid rent will have a balance of 5,000 and that is good for 2 months. So this now separates, or it's separated now, your rental expense and your prepaid rent. So rental expense is an expense account and prepaid rent is an asset account. So the mixed account, which is previously the rent expense, will now be split. So it has a remaining of 25,000 and a new account will be the prepaid rent 5,000. Example number 2. On September 1, 2019, Anis Botanical paid the insurance premium for 1 year amounting to 72,000. The business follows the calendar year. So again, first we need to know how much is our insurance expense monthly. So for monthly expense is 72,000 divided by 12 months. So you have 6,000 per month. So to determine expense, count from it's September now. Count from September to December 31. September, October, November, December. That is exactly 4 months expense. And the remaining 8 months will be asset. So to compute for your total expense, total insurance expense, that would be 6,000 times 4 months is 24,000. Then the prepaid insurance or the asset portion is good for 8 months, and that will be 6,000 times 8 is equal to 48,000. So to prepare the adjusting entry, okay, so upon payment, your record is debit to insurance 72,000 and cash in bank 72,000. Upon payment, again, since you are using an expense account, when you originally record the payment or the prepayment, at the end of the period, you will be recognizing the asset portion. That is why you have a prepaid insurance of 48,000 and an insurance expense of 48,000. So what will happen? This is now you're posting after you have prepared the adjusting entry. So you have there a debit of 72,000 originally. So it's an insurance expense that what existed upon payment. Then at the end of the period after preparing the adjusting entry, you will now have a prepaid insurance account. So it existed na both insurance expense and prepaid insurance account. So under the prepaid insurance account, you have a debit of 48,000 based on the adjusting entry that you've made, and a credit to insurance expense of 48,000 based also on the adjusting entry that you've made. So the expense portion is good for 4 months. That would be 24,000, and the asset portion is good for 8 months, and that would be 48,000. So the asset method, so those, or that would be how you are going to adjust when the prepayment uses expense method in recording the original payment. We'll now proceed to the asset method. So under the asset method, we will be using an asset account title. So you have for payment of advertising, prepaid advertising, payment of insurance, prepaid insurance, payment of rent, prepaid rent, payment of supplies, unused supplies, payment of interest, prepaid interest. So the pro forma entry for prepayment under the asset method, for the payment of expenses, you have prepaid expenses and credit to cash. So if you're going to compare it with the expense method, here it's a debit to an asset account, while under the expense method, it's a debit to an expense account. So for the adjusting entry, here you will be recognizing the expense and you will be reducing the prepaid expenses. It's the opposite. Under the expense method, you will be reducing the expense account and recognizing the asset account. Here, you will be recognizing the expense account and reducing the asset account. So we'll have an illustration. On March 1, 2019, Elaine Jewelry Shop paid the rental for 12 months amounting to 30,000. The business follows the calendar year. Okay, so this is similar to what we did now under the expense method. So now we'll be using the asset method. So if the expense method would debit rent expense, here we will be debiting prepaid rent, 30,000, and cash, 30,000. For the adjusting entry, we will be recognizing the expense portion since what existed is an asset account. So for you to adjust, you recognize the expense. So it's a debit to expenses, so rent expense, 25,000, and reduce the prepaid rent, 25,000. So this is the same computation last time, no? Expense is 10 months and asset is 2 months, and a monthly expense of 25. So after the adjustment, this is what will happen. So at the start, you have a prepaid rent of 30,000. Then after at the end of the period, you prepared the adjusting entry, recognizing rent expense. So it's a debit to rent expense, 25,000, and reduce the prepaid rent, 25,000. So both you have a balance of 5,000 for prepaid rent and rent expense is 25,000. Okay, so I want you now to see the comparison between the expense method and the asset method. Upon payment, if you are going to compare, under the expense method, you will be using rent expense, while under the asset method, you will be using the prepaid rent here. So upon payment, rent expense, under asset method, it's prepaid rent. Then, after the adjustment, under the expense method, you will be recognizing the prepaid rent, and then under the asset method, you will be recognizing the rent expense. And notice that whatever method you will be using, after you have prepared the adjusting entries, you will be having the same amount of rent expense and having the same amount of prepaid rent, regardless of what method you are or you use. So for rent expense, under the expense method, you have 5,000 rather 25,000 here. And under the asset method, you also have 25,000. For the prepaid rent, under the expense method, you have 5,000 here. Then under the asset method, you also have 5,000. So whatever method you use, it will bring you to the correct amount of your rent expense, which is 25,000, and the correct amount of your prepaid rent, which is 5,000. Okay, prepaid rent, 5,000 under expense method. Prepaid rent, 5,000 under the asset method. Rent expense, 25,000 under the expense method. Rent expense, 25,000 under the asset method. So it's exactly the same. Okay, so we now proceed to the pre-collection of income or pre-collected income or unearned income. So pre-collection has been partly earned. So this will be a mixed account. So unearned revenue, commission collected in advance, interest collected in advance, rental collected in advance, advertising collected in advance. So these are examples of our pre-collection or unearned revenue. There are two methods of recording pre-collections. We have revenue or income method and the liability method. So we will talk about the revenue method. The term revenue implies that this method uses revenue account at the time of collection. So meaning the time you receive cash, you record it as a revenue. So we have here some sample or examples of revenue account title. So for commission paid in advance, we have commission revenue. Interest paid in advance, you have interest revenue. Rent paid in advance, rental revenue. Advertising paid in advance, advertising revenue. Do not confuse with paid in advance by the customer or the client to us or to the company. So example, on April 1, 2019, YesFM received 36,000 from a customer for the advertisement. This transaction gives rise to a liability for the business to render advertising service for the next 12 months. So upon collection, you have your entry, debit cash in bank 36,000, credit advertising income 36,000. So take note, what we have is an advertising income and income account. So under the income method. Then for the adjusting entry, but before that, we need to determine what portion is income and what portion is liability. So if we're going to go back, the collection was made April. So if we're going to count April to December, it's exactly exactly 9 months. So the 36,000 is good for 12 months. So monthly income or monthly advertising income is 36,000 divided by 12, it's 3,000. So if you're going to count April to January, rather December, that would be 9 months. So the income portion is 9 months times 3,000, 27,000. While the liability is the remaining 3 months times 3,000 is equal to 9,000. So to adjust, since you recognize the collection as an income, to adjust, you will be recognizing the liability and reducing the income. So your entry is a debit to advertising income 9,000 and a credit to unearned advertising income 9,000. So reduce the income because you have it recognized at the start, then set up the liability. Okay, so when you prepare the T account, so let's take a look on the T account. So upon collection, what you have is advertising income. So you have it here, the original posting. Sorry, this one, the original posting, the 36,000. Then at the end of the period, you prepare the journal entry, debiting advertising income and crediting advertising, unearned advertising. So what happened after you have prepared the adjusting entry? Your advertising income now will have a balance of 27,000, which is the correct amount for income during the year, and establish an earned advertising income 9,000, a liability. So you were able to split the income portion of the 36,000, which is 27, and the liability portion of the 27,000, which is the 36,000, which is 9,000. Okay, how about if it's under the liability method? The term liability implies that this method uses liability account at the time of collection. This is also called as the real approach. So under the liability method, this account may exist for commission paid in advance and earned commission revenue, for interest paid in advance and earned interest revenue, for rent paid in advance, we have unearned rental revenue, and for advertising paid in advance, we have pre-collected advertising revenue or unearned advertising revenue. So on April 1, the same problem. We have no YesFM received 36,000 from a customer for advertisement. This transaction gives rise to a liability for the business to render advertising service for the next 12 months. So this is what happened. So same computation, we have 9 months income, 3 months liability, 3,000 monthly income. So at the start, upon collection, we establish or we recognize the 36,000 as unearned advertising, which is a liability account. Then when you prepare your adjusting entry, or you prepared your adjusting entry, what you did is you reduce the advertising or the unearned advertising, or you reduce the liability by the income, that's 27,000, and you recognize income, 27,000. So what will happen? So this is it. So upon collection, you have unearned advertising, you establish it at 36,000. Then at the end of the period, when you do your adjusting entry, it's a debit to advertising income, and it's a debit to it's a debit to unearned advertising and a credit to advertising income. This is supposed to be credit. I'm sorry for that. I will be correcting my slide later. So this has to be based on our poll or our journal entry or adjusting entry. It's a debit to unearned advertising 27 and a credit to advertising income 27. So I will make corrections later. So what will happen is that your unearned advertising would have 9,000 balance and you will have advertising income of 27,000. This is supposed to be debit or rather credit. Anyway, sa'yo kasal ni siya. So I will make corrections later. I will be providing you with this PDF of this presentation, the corrected one. So what will happen is that whatever method you are using, it will still give you the same amount of advertising income. So for income method, it's 27,000. And for the liability method, it has to be here, 27,000. I will make a correction. It has to be credit, 27,000. I was not able to check it. So it's 27,000. And under the income method, your unearned advertising is 9,000. It has to be credit. Sayop. Then upon under the liability method, your unearned advertising is also 9,000. Sayop, it has to be credit and this has to be credit. Sorry for that. I will make corrections. Just check it after. Okay, so we're done with deferrals. We'll now proceed to estimates. So for this one, we will be talking about provision for depreciation and provision for doubtful accounts. So we'll start with depreciation. What is depreciation? It is the reduction in the value of an asset or wear or tear. So it applies only to property, plant, and equipment. PPE are gradually used up in providing goods and services over time. And the purpose of accounting depreciation is to spread the cost of PPE over its expected useful life. Depreciation is a method of allocating cost of a fixed asset over its estimated useful life. The portion of the cost allocated to a particular accounting period is charged as an expense against revenue. This answers or addresses the matching principle. So asset subjects for depreciation are buildings, furniture and fixtures, equipment, office equipment, production equipment, or your machineries. Then we have vehicles, company vehicles. Factors affecting the life of tangible assets. So we have physical deterioration. Normally, the physical aspect of the assets deteriorate after the passage of time. Then we have obsolescence due to new inventions. Assets will become obsolete. And then wear and tear, the normal wear and tear of assets. And then, of course, passage of time. So after passing how many years or after many years have passed, assets or tangible assets would really become, or the physical aspect of assets would really deteriorate now after the passage of time. So there are four main factors to consider when calculating depreciation expense: the cost of the asset, then you have the estimated salvage value of the asset, then the estimated useful life of the asset. Three factors again, sorry. Three factors: the cost of the asset, the estimated salvage value of the asset, and the estimated useful life of the asset. Another correction. Okay, depreciation methods. Actually, we have a lot of methods on how to compute for depreciation. We have straight line, production or output or service hours, and sum of years digits, double declining balance. But in our discussion, we will only focus on straight line because in higher accounting, you will be introduced to this different computation of depreciation. So straight line allocates the cost of the asset to expense evenly over years asset is used. The life of the asset is measured in years. So to compute for the annual depreciation is cost minus expected residual value divided by expected life. So the pro forma journal entry to record depreciation is a debit to depreciation expense fixed asset. You have to name like depreciation expense building. Then accumulated depreciation fixed assets like accumulated depreciation building. So example number 1, Triple D Corporation purchased a machine that cost $50,000 and estimated to have a life of 5 years on January 1, 2016. A salvage value was not assigned to the assets, meaning there is no salvage value. Determine the annual depreciation expense using the straight line method and prepare the journal entry to record the expense. So to compute for the annual depreciation is 50,000 minus 0 divided by 5 years. So the annual depreciation is 10,000. So the adjusting entry, debit depreciation expense 10,000, credit accumulated depreciation 10,000. So I just want to show you the lapsing schedule of our asset. So you started, it's 5 years, the asset has 5 years life. So we have 2016, 2017, 2019, 2020, 2021. The cost of our asset is 50,000. Our annual depreciation is 10,000 every year. Then accumulated depreciation. What is accumulated depreciation? If you remember, accumulated depreciation is a contra asset account, meaning this is an asset offset or an asset deduction account. So what will happen to your accumulated depreciation? Your accumulated depreciation will increase by the amount recognized as annual depreciation. So for the first year, your annual depreciation is 10, your accumulated depreciation is 10,000 also. Now, for the computation of book value, okay, what is book value or net book value? This is the amount you need to present in your balance sheet. To compute for the net book value, it would be the total cost of the asset minus the accumulated depreciation. So it's 50,000 minus 10,000, you have 40,000. In 2017, another annual depreciation of 10, your accumulated depreciation now will become 20. So the book value is 30,000. That would be 50,000 minus 20,000 is 30,000. Then at the end of 2019, your accumulated depreciation is 30,000 now after an annual depreciation of 10. So the book value is 20. Then in 2020, another depreciation, your accumulated now will be 40 and the book value is 10. And at the end of the year, the book value of your asset should be 0. But if you wanted to use still use such asset for inventory purposes, it should have a book value or a remaining value of 1 peso for inventory purposes. Yeah. Okay, so this is how you will do it now when you depreciate an asset. So annual depreciation, since you are using straight line, is equal every year. Your accumulated depreciation will increase by the amount of your annual depreciation. And your book value or the net book value of your asset, which would be the amount you need to present in your balance sheet, should be cost minus the total accumulated depreciation. Okay, so that's how you do it for a 5-year life asset. Sample number 2. Assume a business purchases an air conditioning system for 100,000 in 2016 and with an installation cost of 15,000. The useful life of the air conditioning system is for 10 years and with a residual value of 20,000, calculate the depreciation expense. Now this time, it's not only that we have the purchase price, but we also have the installation cost. To compute for the total cost, it should be the purchase price plus any incidental expenses incurred to make the asset ready for its intended use. So for this problem, in this problem, we have 100,000 purchase price and an installation cost of 15,000. So the total cost of the asset is 115,000. Then we are also given a residual value of 20,000. The other term for residual value is scrap value or salvage value. So residual value, scrap value, or salvage value, they mean the same thing. Okay? So to compute for the annual depreciation, it's 100,000 plus the installation cost of 15, a total cost of 115,000 minus 20,000 divided by 10 years estimated life. So the annual depreciation is 9,500. So your adjusting entry should be a debit to depreciation expense 9,500 and a credit to accumulated depreciation 9,500. So this is the lapsing schedule. So this is now different as compared to the other one because we have a salvage value or a scrap value. The scrap value should be the amount remaining at the end of the life of the asset. So you have it there. We have annual 9,500 depreciation. Then our accumulated is this one. So at the end of the 10th year, the remaining book value should be the scrap of 20,000. Okay, so the process is the same what we did with the first problem. Okay, next we have estimate for allowance for doubtful accounts. So doubtful accounts, these are customers' accounts arising from sales of goods and services on credit but become doubtful in collectability. Reasons why accounts are not totally collected: debtor losses capacity to pay, customer is not willing to pay, customer cannot be located anymore in the designated address, then customer dies. So these are the reasons now we can no longer collect our accounts receivable. So we need to determine or estimate how much of this receivable, current receivable, could have a possibility of not being collected. So the pro forma journal entry to record doubtful accounts is a debit to doubtful accounts and a credit to allowance for doubtful accounts. Basis for estimating doubtful accounts, we have as a percent of sales, as a percent of accounts receivable, based on aging of accounts receivable. Okay, percent of sales. The basic mathematical process appears as follows. So total credit sales or revenue times percent of doubtful accounts. The result is doubtful accounts or bad debts. So your entry, for example, on December 31, 2019, Triple D Recording Studio provided the following information: income 35, accounts receivable 21, allowance for doubtful accounts 50,000. Compute the doubtful accounts expense and prepare the adjusting entries. So take note, we are using the sales percent of sales. So we have service income since we base it on the income or sales. So 35 times 5%, the doubtful accounts rate. So doubtful accounts expense is 175,000. Now take note of this. If the basis is an income statement account, the resulting item should also be an income statement account. So since we are basing it on income, the result will be our expense for the period. So when you prepare the journal entries, that would be the amount you're going to use. So debit doubtful accounts 175, then credit allowance for doubtful accounts 175. That is based on sales. Then we have percent of accounts receivable. So the basic mathematical process appears as follows. Outstanding accounts receivable So this time we will be basing our computation on AR, which is a real account or a balance sheet account. So when you multiply it for percent of doubtful accounts by the percent of doubtful accounts, the result will be the required allowance for doubtful accounts. So it's no longer the expense, it's the required. So example, on December 31, 2016, HBB Aircon Services provided the following information. Service income 3.5, we have the same problem. Accounts receivable 2.1, allowance for doubtful accounts 50. Compute the doubtful accounts, then prepare the adjusting entry. Okay, so this is different now because we base it on the AR. So it's 2.1 times the doubtful accounts rate. That should be 5%, I'm sorry. I will be correcting this one. So the required allowance for doubtful accounts is 105,000. So is the 105,000 ba the amount we will be using in preparing the adjusting entry? No, because the 105,000 is the required allowance of doubtful accounts, or that would be our allowance of doubtful accounts, allowance for doubtful accounts end. So since that will be our required allowance, we need to consider whether we have still an allowance balance existing in our balance sheet. And in our case, we still have 50,000. So since we are required to have 105 and we already have 50, so we need only 55,000 for our doubtful accounts expense. So when you prepare the adjusting entry, it would be doubtful accounts 55,000, allowance for doubtful accounts 55,000. Okay, so it's different compared to we base it on sales, because if we base it on sales or income, in the computation, automatically the amount is the one we make use in preparing the journal entry. Look at this one. So we base it on the 35 times 5%, 175. So when we prepare the journal entry, it's 175 because it's sales. So the resulting amount should also be our expense. But it's different here because we base it on the accounts receivable, which is, again, I said, a real account or a balance sheet account. This is supposed to be 5%. So the resulting amount of 105 should also be a real account. So meaning, this is your contra asset account for AR in the balance sheet. This is the required allowance. So since we still have an existing allowance of beginning, no allowance beginning as given of 50,000, so we need to recognize more, 55,000. Okay, not the entire 105. So it's 55,000 only. So this would be our entry. And I was not able to give you an example of an aging. I'll just add one slide in this presentation, and please na lang read. So how do you present your accounts receivable in the balance sheet? The accounts receivable should be presented at net realizable value. So this refers to the value of the receivable after deducting allowance for doubtful accounts from the outstanding balance. So in our case, we have accounts receivable of 2.1 minus the required allowance of 105,000. The net realizable value is 1,995,000. This is the amount you're going to present in the balance sheet. So concepts related to estimation, I think we have discussed this. In some of this we have discussed na, no? So we have systematic and rational allocation. Allocate the cost of the asset used to generate income over several years. So example, the depreciation of our building, depreciation of our equipment. So these are, or this is an example of systematic and rational allocation. The matching principle requires that depreciation allocate the cost of the asset over the useful life of the asset. Okay, then we have immediate recognition principle. A cost that produces no future economic benefit shall be recognized immediately as expense, like insurance expense, interest expense. So that's there's no future benefit because they're incurred already. So it has to be recognized immediately. An asset that ceases to provide future economic is recognized immediately as expense, like accounts receivable. If it cannot be collected na, then it has to be outright no recognized as a loss na. So we have to provide for doubtful accounts. Then we have three expense recognition principle. We have matching, systematic, and rational allocation, and immediate recognition. One is latong three expense recognition principles. Okay, so thank you. That ends my presentation. So utangan pa ko ninyo, I will give you pa the aging and the comparison. So I'll just add that one in my slides. So please review. So I will be posting this presentation in a PDF file and the video I did today. Thank you.